Welcome back. We have been discussing with an elite panel of bankers and economists, Mr. Dinesh Khara of SBI, B. Prasanna of ICICI Bank, Mridul Sagar, former RBI Executive Director and member of the MPC, and Samiran Chakraborty of Citi. What they made of the monetary policy and how the economy and the banking system evolves here on. Mr. Khara, there was a mention that banks are giving top-up loans over both home loans and gold loans, and that's something that's worrying the RBI. We have also seen actually an increase in NPAs in several quarters. MFIs definitely, but even some unsecured loans. Do you think that the best of the asset cycle is behind us, especially in the retail sector?
Well, I think the concern which was expressed by Governor was essentially coming from the fact that some of the banks are not looking at the end use of the top-up, etc., which has been given for the home loan as well as for the gold loans. So that is one of the reasons. And when it comes to the LTV ratios which are being looked into while extending these loans, and also EMI, NMI ratios which are being looked into. This was one of the major reasons when for the unsecured loans, the RWAs were increased. So now this kind of practice was seen in some of the quarters, and that is one of the reasons why this was flagged by Governor in this policy statement. So I think, here again, depending upon, we have seen that in some of the MFIs, we do see some such scenarios. But as far as we are concerned in our book, not really much of change which we have seen in terms of behavior. So I think, again, it's a very fragmented market. In certain segments, perhaps it is seen, but not. Yes. It is not a universal behavior which we get to see.
Yeah, he made it clear that it is only certain entities. Yes. He repeated that phrase. But, there are some NBFCs and MFIs where the numbers looked quite bad in the first quarter. And very quickly on this matter of, higher liquidity coverage ratio, which is imminent, are you getting a sense that they will give you more time? Because when we asked him that question, he said it's only a draft. There was an emphasis on only, which gave a sense that it's either diluted or delayed. I mean, did you personally have any conversation with him?
Well,
with
I think
anyone in RBI?
In fact, we are all sharing our thoughts on this particular paper. And we are sharing through IB as well as directly also. And I'm sure RBI always gives us an opportunity to explain our stance. They will be very mindful of what our views would be. And only then some regulations will come.
Okay, that's good to hear. Twofold questions to you, Prasanna. If this goes through the LCR, there is a huge, people are guessing between 3 lakh crore and 5 lakh crore demand for bonds. And to that extent, credit will also fall because, banks will put their money into HQL, into bonds and not give it as loans. What is your sense about what can happen to the bond yield over the next 1 year, over the, say up till December or up till March, if you can give me a range, if the LCR rule is as is and if the LCR rule is not as is?
No, but Latha, a broader point actually, I think, refer to the fact that we have repeatedly spoken about financial conditions actually being very easy. But that is if you look at the financial and capital markets like you spoke. But if you really look at outside of it, there has been a craze for getting deposit growth, and there is actually all these, even the LCR guidelines, for example, presses interest rates in the system on the tightening side. So you have this contrasting pressures which are happening. And so to that extent, I think there might be at the margin some kind of a shifting of funding which could happen. But at the same time, like Mr. Khara said, it might not be viable for too many corporates because it's only the better rated corporates who can really access the capital market. But on the issue of on the LCR itself, I think, see, the calculations depends upon what percentage of retail deposits every bank has and so on and so forth. But broadly, people have made around 4 lakhs to 5 lakh crores as the incremental GSEC demand if people will have to want to keep the same level of LCR ratio as they were keeping prior to the guideline. Now, that is again a call. People could say, I mean, the banks which are maintaining, say, 125 to 130, 135% can probably dip into the cushion a little bit. So even if you assume, say, 3 lakh crores of demand comes in and not 4 lakh to 5 lakh crores, that's nearly around 20% of your annual, supply. So to that, or maybe 15% of your annual supply. So to that extent, I think it does make the demand supply situation favorable for government bonds. And also bear in mind that this is the year when you get the one-time index inclusion flows also coming in. So net,
So what is the range?
So I think it is it's a narrow trading range that is happening, but a range which is consistently going down. I would say it's around 685 to 690 in the shorter time frame. But over a medium-term time frame, I think it can inch towards 680 or maybe even slightly lower than 680. But this is all subject to, US data playing ball. You're not really surprised and at a hawkish kind of a Fed and all that. So all this, taking into account, I think looks like 680 seems like something that we will gradually move to.
Okay. Mr. Khara, I can see you looking at your phone. I'll thank you for sparing time with us. I know it must be a busy day for you. Thank you very much for being with us. I'm not done with the economists and the bond expert. Samiran, a similar question to you. What are you expecting in terms of a bond yield? But more importantly, what are you expecting by way of currency also? We keep writing for headlines' sake, all-time lows, but the rupee has actually outperformed. So your range for the rupee as of December 2024 and bonds.
First on bonds, I think the bigger move, already a significant move has happened on the back of the positive macros, including the fiscal being very conservative, inflation numbers behaving quite well, global deflation story picking up steam. From here on, the next leg of the move has to coincide with farm rate cut expectations from RBI. That, in our view, is probably delayed till first quarter calendar of next year, fourth quarter fiscal. That's when we expect yields to drift closer towards 650, 660, 10-year, that sort of a level. And on the currency side, we have practically forgotten looking at the valuations of the currency. And if you look at the 40-country RER, that went up above that 106 mark in June. And historically, that 106 has acted as some sort of a resistance level. And now we are seeing that in July and August, that is retracing back into that 101 to 106 range where this RER has stayed for a long time. So this is a little bit of that adjustment on the valuation side that we are seeing. So we had a target for about 84 on INR. That's where it's settling down. But from here on, it will depend much on where the DXY is going to move based on Fed rate action.
Okay. Fair point, of course. There are too many imponderables. Mridul, I'm completely out of time, but I'm going to take the liberty, a 10-second answer. The economic survey threw this question that should the Reserve Bank or the MPC only look at CPI minus food? Should we take that seriously, or will life go on as before?
I think the life needs to go on as before. This has come up as an issue. But even when the inflation target was set, there was a clear big debate within RBI on this. And we took the call of making headline the matrix, essentially because frequent supply side shocks and large supply side shocks lead to generalization of the inflation. No country in the world is sort of targeting core as its measure. Even the advanced economies are actually looking at the headline numbers of the CPI inflation. So the matrix can't really be changed when you have food as 46% weight.
Fair enough. I believe it is only Japan and Thailand. So perhaps that's a debate which is uncalled for at this juncture.
Correct.
Thank you very much, gentlemen. Out of time. So it does look like the RBI status quo policy has all of your agreement. Thank you very much for joining in this special monetary policy discussion.